Active trade management. I wanted to keep this concept for later so that it does not make the communication of base knowledge unnecessarily cluttered. And moreover, this is more of an approach and is not related to a specific trading strategy. A trader can use active trade management, irrespective of the position size or time frame or the strategies that they use. After entering a trade, beginners usually don't do anything till their profit target is met or stop loss is hit. On the other hand, many intermediate and advanced traders would usually not enter or exit trades in one go. They scale into their trades and scale out. Note that the scale in should not be confused with averaging down that we discussed previously. You add to your position only if it is going in your direction. When you enter a trade, you have some information on the chart. As the price moves further, you gather more information on that ticker you are in. You see the movement, pattern, volume, etc. That gives you additional knowledge to judge whether the price action is supporting your initial strategy. Based on this additional knowledge, while you are in trade, you can make informed decisions on adding to your initial position or exiting some. This approach lets you get into a position with limited risk, and then you can add to your position if the price is moving in your direction. Let's look at a simple example to illustrate this. Consider the chart here. Let's say, based on some strategy, you decided to enter at point 2 for a short trade. Stop loss is at point 1. Your initial target is 2R, or when the price movement starts to weaken or reverse. At point 3, we have touched our target and can take a partial exit, but we see the movement is strong, so we just move the stop loss to point 2, which is the point of entry. So our stop loss is at the entry point, the break-even point. So now we are riding this trade without any fear. We cannot lose any money on this trade except for the commissions involved. One option is to leave this as is and ride the wave. But if you see a higher probability of further movement, you can add to your winning position. Let's say you decide to add more shares to your position at the pullback at point 4. Now, the break-even point is no longer at point 2, but will move to a point between 2 and 4, depending on the number of shares added. Let's say you entered with 20 shares at point 2, and then at point 4, you added same number of shares, that is 20. Then, the new break-even point will be midway between 2 and 3. You may either decide to move your stop loss to this new point to be very safe, or keep it at the original position at number 2. In the former case, your stop loss may get hit with slight fluctuations, taking you out of the trade at break-even, and in latter, you can lose money if the price reverse, but it gives you more room to make up for some fluctuations. For this reason, I would not recommend the add-ons to be very high. I usually add 50% of the original position size in add-ons. So, if I entered with 20 shares at point number 2, I would only add about 10 shares at point number 4. So then, even if I move to a new break-even, I still have some room. But usually, after adding on, I don't blindly move my stop loss to break-even. I prefer to move it down to a technical point or level, like the level C in ABCD, or a support or resistance level, or moving averages, etc. Then in a similar fashion, you can exit in steps. If you see some sign of weakness, which we see at point number 5, we can exit some. And then, you can keep the rest, in case the price moves further in your direction. I would usually exit a major percentage, about 75 to 80%, if I see sign of weakness. And then, I let the rest 20 to 25% ride the wave all the way, or till it hits my break-even point. I may sometimes make some more smaller exits along the way. How much you exit is again your personal choice and a function of your overall strategy. Here is another example. We took an entry here at point number 2, with stop loss at this point number 1. We added to our position at point number 3 as it moved out of the small range. We also moved our stop loss to a new technical point. We could also move it to break even, but I prefer a technical point. We rode all the way up and then took a partial exit at point 4 when we saw some sign of weakness and it closed below the moving average. We keep the rest just in case it continues in our direction. But then we were stopped out at point 5, the point where we had moved our stop loss to. Active trade management takes time to develop as a skill. As it involves real-time decision-making, you need a lot of practice to get the hang of it. Try it on the simulator first, before you start trading with real money. One important note before we move to the next section. In this approach of scaling in and scaling out, you will end up paying more commission as you are taking multiple trades. This is because most of the brokers charge a minimum fee per trade. You will learn more about this in the next chapter. Initially, when you are in the learning phase and your dollar risk is small, like $20 to $25, the commissions may hurt a lot as they consume a heavy portion of your profits and losses are accentuated further. But once you achieve consistency and are ready to up the game with higher risk, then this cost will start to become a much smaller percentage of your profits.